Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder, CEO of Shepherd Wealth Management. Very excited to be back here on the mic for today's podcast. We got a lot to cover. We got some brand new inflation data that caused the market to lose its mind for at least one trading day. We got some additional news regarding unemployment. Obviously, we're wrapping up earnings season here, so we'll talk a little bit about that today. With the main segment kind of getting into my takeaways regarding the CPI report that we got a couple days ago, the reaction that the market had, kind of why I thought that was very much overdone, but somewhat expected. We've been talking about a Q1 pullback at some point, in this quarter. I think we just saw that. So that's going to be the main segment today. And as we're going to kick it off with some tax questions that we're getting from some customers here at Shepherd Wealth Management. So we got a full show today, man.
I'm here for it, obviously. Yeah, right above your shoulder, the good angel.
I like it. I need it because there's a dichotomy. One's like, you're killing it. The other one's like, oh man, maybe you want to lose your mind like the market did too. You know what I'm saying? Like you have those two talking heads on either side of your shoulder. So
well, it is a house of madness. I mean, as you know, the financial advising world is basically just the movie Event Horizon played out in real time.
Yeah, absolutely. Yeah, the market is basically just a live autopsy of human emotion, and it's playing out, this week right in front of our very eyes. I know, and that's kind of the main reason why we do the show, right? We've talked about it, at least for a couple of seconds, almost every show. We enjoy doing this, and the reason why we've gotten such good feedback over 4 seasons. I don't know how many hundreds of videos we actually have up there on YouTube, as maybe you know.
We're close to 1,000. Yep.
Yeah, we're going to join the illustrious 3,000 club at some point. That's a big deal in baseball, 3,000 hits. So
yeah, we'll get there.
We'll get there. But almost 1,000 videos.
Bernie Mac. That was a good movie.
Mr. 3000.
Mr. 3000. Yeah.
Good one. But yeah, I mean, the main reason why we do this show is because we do know that investors are human beings. First and foremost, humans make up a market, and we know that humans are busy, but we all have these really cool smartphones on us these days. With our busy lives, we get these headline risk news from CNN or Fox or wherever you get your data, Barron's. And usually the news is designed to placate to one of our human emotions, fear or greed. One thing that the publicists, advertisers do know about human beings, thanks to studies of behavioral finance, is that we feel losses twice as much as we feel good about making a profit, which means that we are risk averse by nature. So if the headline is anything to do with placating to human beings' fear, but we feel that the most. So we tend to respond to it the most. And I'm not knocking the news; they're doing their job. They're selling ads. Like that's how they make a profit. So.
Yeah.
I have no problem with any news outlet letting you know, hey, this is a headline risk. But one thing that we do not like about the process that the news goes through is it doesn't do a great job in general of providing a lot of historical data around that risk. So whatever the risk is, unemployment, the Fed, inflation, you pick your favorite thing to get afraid of. And there's almost always a historical precedent as it relates to the stock market. The only exception to that was the pandemic. With COVID, the whole world kind of getting shutting down. There is no, playbook for that. There's no precedent for that really. But outside of that, there's always been some sort of historical precedent. And obviously, past performance is no guarantee of future results. Investing involves risk, including risk of loss. But the reality is that human beings, the one thing that Buffett talked about with human beings is the one thing we know for sure, he said is, quote, humans don't learn from history. And human beings, we tend to repeat our behavior quite a bit. We haven't changed all that much in a couple thousand years. So once we understand what the risk is, and thank you for the news for that, now we can start to say, hey, what's the precedent for this? How many other times have we been through something similar? And if we can get, a lot of different data points that says, yeah, this was the risk and we've done this 17 other times and here's what the performance was of the S&P and of the 11 sectors of the S&P, now we can start to put some probabilities in our favor as we go about building that asset allocation for customers. So very much customized here at Shepherd Wealth Management, but that's the real reason why we love doing the show, why we've had such good feedback, is because when we understand what history has to say, it does 2 things. One, it gets us a little bit of an edge for putting probabilities in our favor from a historical precedent. But the most important thing that it does is it controls your temperament, your emotions. And Buffett talks about that being the most important thing that prevents individual investors from being able to achieve the types of long-term success that they're striving for when it comes to their portfolio and the investments they make in stocks and bonds. So we think that that's very valuable, very, very important. Probably the most important thing to get a handle on is your temperament and your emotions. You can make more consistent, better decisions with your portfolio. So that's the main reason for this. We enjoy the heck out of it, and certainly hope you all do as well. You can find all those videos, by the way, that as just mentioned, almost 1,000 of them at this point, shepherdwm.com. Takes you right to, at the top of the page, a link to our YouTube page. While you're there, we also have links to Spotify, but we can also provide you access to our monthly newsletters we send to clients. We also write a weekly blog on Fridays, almost every Friday. So all of it's right there on the website. And obviously, you can get a lot of good information about myself, the company, and all the things that we're here to do for folks. So blessed to be able to do it, Ez, but it is tax season.
Yeah. Oh, God. It is.
So, with a blessing, there is always some pain points that you got to go through. And everybody in this country has to get their taxes done.
Yeah.
Right about the middle of every April, which is kind of dumb. I'm going to give you, this is just me ripping here for just a second. So I am the middleman for our customers for tax season. And what I mean by that, for households that we have of $500,000 invested that we're managing for that household or more, we provide the ability to prepare and file taxes for those customers through our CPAs. And if they've used their own accountant, that's great. We give them a tax credit up to $600 to cover those costs of preparing and filing.
That's awesome.
But what makes this dumb? And I have confirmed this with all the CPAs that we work with. So we work with 3 CPAs, 2 here in Ohio and 1 in Pennsylvania. We have clients through 11 different states. So that kind of helps us out from a geography standpoint. But what makes it dumb is we're custodying all these accounts through Charles Schwab. And that's not the dumb part. The dumb part is Schwab, Fidelity, Vanguard. You know, you pick any one of these big companies, a big bank, JP Morgan, that has an investment arm where people can access the stock or the bond market. Well, those custodians, Schwabs of the world, et cetera, they have to get out these 1099s, all these tax forms to everybody that has an account, right? Because everybody that has an account has a social security number and all that, you know, jives up with the IRS. That's how they keep tabs on everybody, making sure that you're paying your fair share of taxes, or at least supposedly that's how it works.
Yeah.
But the problem is they got millions of accounts, which is, you know, a multiplier of data, right? You got millions of accounts, and there's, you know, an exponential amount of data that goes on that they have to organize and then send out to everyone before they file their taxes. But the problem is they don't have enough time to do it, really.
Right.
They don't have enough resources. They don't have enough people. They cannot do it fast enough. They're getting a ton of phone calls right now. People are doing their IRA contributions on top of all that before April 15th deadline. And that counts for last year, by the way. On top of the required minimum distributions that people are probably taking out at the beginning of this year that don't want to have to wait till December. So this is just an extremely busy time of the year for every custodian that has an investment arm, whether you're a bank or, you know, a company like a Fidelity or what have you. You just don't have enough time. So what the issue actually becomes is I get all this data from Schwab in this example for all of my customers. Like I have a lot of customer data, but I'm still waiting on Schwab to give out the 1099, let's say. Well, the accountant can't do the work that they need to do in preparing and filing taxes until they get all of that data. And they usually don't get it till like right at the end of March.
Yeah.
So they got like 2 weeks, 2.5 weeks maybe, to get through their customers hundreds and hundreds of pieces of tax data and then prepare and file that accurately. So we're all kind of just talking as a group of financial professionals, myself and these CPAs, and it would just make a lot of sense if anybody in the IRS is watching or cares about our opinion at all, to maybe have people's tax deadline be their birthday. That gives the custodian more time to spread out all that work because they know when your birthday is, of course. And it would make things a lot easier for the CPAs as well. So that's just my 2 cents on that, Ed. I don't know if you have a opinion on that or not, but
well, I mean, the January birthdays are going to get boned pretty hard on that system, you know. If you're still spending money up until December 12th and then you got to file your taxes by Jan 3rd, that'd be pretty hard.
Yeah, I guess you'd have to like maybe make a small exception for a Jan birthday.
I mean, yeah, you could just say April 15th for anybody born before that. I think they should have a 2-tiered deadline where it's like you're legally bound to submit your tax info to your to your customers by like March 1st, but then extend the tax deadline to like, June 1st so that everybody has enough time. I mean, that makes sense. It's like you get 6 months into the next fiscal year to prep and file everything. And then, because you're right, man. I mean, it sucks when you're waiting on people. You're pretty good at it. I get your stuff real fast when it comes tax time. But yeah, you're waiting on other folks and they'll give you a call like, hey, we didn't know where to mail it. It's lost in the mail. And it's like February 23rd. You're like, that's not helping me out.
No, not even a little bit. So anyway, that's just me here at the top. But that gets right into the first segment here, tax questions from customers. So what's the difference between a deduction, an exemption, and a tax credit, Ez?
Ooh, yeah. What is
the question, right?
Yeah.
All right. So here we go. I'm going to walk through this kind of quick. So let's start with deductions. Deductions and exemptions work very much the same way. They basically are reducing the amount of income on which you owe taxes, which of course decreases your tax bill. For example, if you took a $1,000 deduction and you fall in the 20% tax bracket, as you would save $200 on your taxes. If you receive a $1,000 exemption, that's $200 less you owe in taxes. So effectively, a deduction and an exemption is the same thing. Even though deductions and exemptions work the same way, deductions pertain to stuff, such as exemptions for student loan interest, home office expenses, charitable donations, and literally like hundreds of other variables would fall underneath that category. While exemptions are what you receive for yourself, your spouse, and any child or children or other dependents you may claim, whereas credits are different from deductions or exemptions. Credits reduce your taxable income. They directly decrease your tax bill. For example, if you receive a $1,000 credit, you pay $1,000 less in taxes. So credits are more ideal as far as reducing taxes are concerned. But deductions, exemptions, very, very similar things. So I understand the question. And there you go. So that's kind of a quick rundown of some of the differences there between deductions, exemptions, and credits. Hopefully you caught all that as well before you went to prepare and file your taxes this year.
I did. Yeah. Actually, I have an accountant that I've been going to for a long time, a CPA here, and they did my parents and then also did my grandparents. So a lot of trust going on my end. And certainly as an artist and someone who also works for Shepherd Wealth Management, I can get pretty convoluted with the deductions and everything. So they're really great with helping me out with that. I trust them. So.
I highly recommend everybody working with a CPA. I mean, literally, unless you're like a college student with a part-time job and have the easiest, tax return of all time.
Yeah, no, it's worth every penny every year, man. It's great. I also would recommend anyone who's in any kind of work with any kind of deductions, no matter how much you think you can do it yourself, just always have a professional help you out. It's so stress-free, and it's worth every penny every year. So.
Yeah, and if you're a household that's $500,000 or more, you're not even paying for it. Here at Shepherd Wealth Management. So
yeah, well, I'm on my way.
Absolutely, we're going to make it happen. The good news is you have time, which is the most valuable asset. So I did want to get into a couple other things. We got some data regarding unemployment. We got some earnings data I want to get to, but really the crux of this entire podcast today has everything to do with the CPI data that we just received. So I'm going to touch on the CPI. I'm going to bounce around a little bit here today, because I think all these different, segments of today's podcast are kind of intertwined. So I'm going to be moving around here a little bit today. So first off, the data was this. A couple of days ago, we got the latest January CPI data, and it came in a little higher than consensus expected. Now, we still believe here at Shepherd Wealth Management, I'm going to point to the things as to why we feel this way, that inflation is in still fact on a glide path towards that 2% target that the Fed is looking for, despite the data that we just got. So here's the data, though. Core CPI came out a couple days ago. Economists were expecting 0.3%, came in at 0.39%. So a little hotter than expected. And that caused the sell-off that Ez was referring to at the beginning of today's podcast. Essentially, everything was down 2% or more, or right about down 2% or greater. As Ezra pointed out, I think the Dow Jones was down like close to 500 points that day.
Yeah.
Because of that hotter data. Now, we've been talking about this for a while now. I think that this is the major risk of the market. People are going to want to talk about earnings or the unemployment rate or geopolitical risk. I think that it still remains the main risk in the market is, when is the Fed going to make their first interest rate cut? How many times are they going to do it? Everything is priced off of that. Of course, earnings still need to hold up. And of course, we still do not want the unemployment rate to spike. Those were all bad things. And we're not seeing any of those things. Unemployment has remained very low, under 4%. And earnings have been nothing but fantastic. So we're going to cover that. We did get one hot CPI data. I think there's a little bit of noise here in the data. I'm going to cover all that here in just a second. But after that data and after that market sell-off, now we start to see things like this headline article from Barron's. And here's the headline. This is yesterday. So this is on the heels of that hot CPI report, market selling off quite a bit a couple days ago. And yesterday's Barron's headline that caught my attention says this: the stock market is trying to recover. So yesterday we tried to make a little bit of a recovery. We did. Today, yet we're still trying to make some recovery from the sell-off that we had 2 days ago. And we're kind of stalling out around the flat line here for pretty much all the major averages. But the headline saying, why could it drop another 10% from here? Right? So this is the type of stuff that you're going to get an alert on your phone saying, hey, the stock market is trying to recover. It petered out, but there's a real risk of maybe a 10% drop from here. And Barron's is, at least this author of the article, is trying to make a case for why that might actually happen. And essentially what it comes down to is people's belief that the market is just very, very expensive. So getting into the middle of this article, the author is writing, quote, looking at the correlation between the stock market's earnings multiple and Fed funds futures, meaning the interest rate on the Fed funds, and corporate earnings, the S&P 500 should be trading at just over 18 times earnings, according to Seaport Research Partners. But the index, meaning the S&P 500 index, is trading at about 20 times analyst aggregate expected earnings for the coming 12 months. Yes, that is true. But if you got to break this down, if you're going to call the Magnificent Seven, like if you're going to give a lot of credit last year, which you should, for the performance of the major averages being lifted by really 7 big large cap tech stocks, you're going to single out those 7 stocks. We should probably single out those 7 stocks from the actual earnings multiple of the S&P, because those 7 stocks represent nearly 30% of the whole index for the S&P. So if you remove those big name tech stocks, the Apples, the Microsofts, the Nvidias, and Teslas of the world, etc., you get a multiple in the S&P that is very attractive. It's right about 15.5 times forward earnings. So I get that this author is trying to make a case as to why the market can drop another 10% from here due to a hotter than expected CPI print, which is the main risk of the market. And if they're also going to say, well, the market's very expensive, even though earnings are holding up for most S&P 500 sectors, yeah, you do have a pretty strong case. You have the most important risk, inflation, and this, at least in the most recent report 2 days ago, going up, and this author trying to make a case for why the market is very expensive. But they're painting a very broad brushstroke here with this article without providing a whole bunch of context, and definitely not providing any historical context whatsoever. And that's the main reason why I love doing the show and I love my job, is because I do have the time. This is what I get to spend my time doing, is not just seeing what the risk is that everybody else sees, because everybody else is probably getting the exact same sort of information through whatever push notification they have on their phone, they're getting very similar messages. Market could be at a top. Maybe there's a 10% drop, and they hit a couple bullet points as to why that is. And if you don't have any freaking time to like do your own homework and look at the history of all this sort of data, then you're probably going to make a lot of the decisions that a lot of retail investors made, which is I should probably just sit it on the sidelines here, clip my 5% coupons, and be thankful that I can get it. But that cost investors quite a bit of opportunity cost last year, with the market being up 24% and about $5.5 trillion was sitting on the sidelines collecting just 5%. So that's the main reason why we do this. And this is yet again today another example as to why the individual investor will probably struggle to not just get the type of performance that the market's going to give you just by participating, but they're probably making a lot of their own bad decisions due to the fact that they simply don't have all the information, or they're not willing to take the time to go get that information. So please tune in, subscribe, ask questions. This is definitely your program and your show to get you caught up very, very quickly.
I'm a fan. I listen every time. So,
and yeah, we're getting a lot of new people subscribing as well. Kind of taking advantage of all this stuff. So we certainly appreciate that. Now, when we talk about earnings for just a second, so we have 63 companies reporting this week. That's about 76% of the S&P 500 has reported so far. It's about 380 companies. 80% are beating estimates, and those that are beating by a median of 7%. So the data here from an earnings standpoint has been holding up this entire quarter, which is definitely something that we had expected. And I definitely believe that that's still going to remain a very important thing to keep an eye on for the remainder of this year. Is earnings growth on these S&P 500 companies, but still yet the main risk is inflation. And I'm gonna get right to that, but I also wanted to make sure that we talked about the actual backdrop of the consumer. So the S&P 500 is made up of 11 sectors, of course, but consumers make up 70% of the economy. So the importance of that is as long as the consumer has a job, or at least all of those that want to work can find work, that's a great backdrop for a very strong U.S. economy, which we do have. And we confirmed that this morning when we got the initial jobless claims. Initial jobless claims came in at 212,000. That dropped by 8,000 from the prior week. So again, everybody that's looking for a job has one. Analysts and economists were expecting jobless claims to tick up to 220,000, actually drop. So we have corporate earnings that are almost over, and will be over here in the next, let's say, week and a half. Corporate earnings, fantastic. U.S. consumer has a job. And I know that we have a hot inflation print just a couple of days ago, but I'm about to give you some details as to why I think there's some noise in that data, and I don't believe that that's actually going to change the trajectory of what the Fed's plans are for interest rates here in the future. So let's take a little bit of time and talk about that here this morning. So as we mentioned, CPI came in a little hotter than we had expected. That caused the bond market to sell off, meaning that interest rates went up. So the 10-year yield as went from 3.8% just a week ago all the way up to 4.285%.
That's
on the back.
Drastic.
I mean, it is, right? I mean, that's a huge move. Nearly a 50 basis point move in a week for the 10-year. I mean, that's nuts. That's like having like a 20% move in the S&P in like a week. Right? It's not saying it's unprecedented or impossible. It's just when it happens, you're like, damn, I can't believe that just happened that fast.
Yeah. I thought maybe you'd say like at the most 30 points, but no, that's bizarre.
So yeah. And there's a huge correlation, right, between interest rates and the market. That's why I believe that inflation and the path of inflation, what the Fed's going to do with interest rates, is the key risk. Because everybody that's out there doing this job of providing guidance or making investment decisions on behalf of individual investors and households, they're trying to price in our securities fairly valued, overvalued, undervalued. They're using some sort of discounted cash flow model that requires some sort of discount, interest-free or risk-free rate is what they typically call it. That would be something like the 10-year U.S. Treasury. And as that goes down, that makes the future value or the present value of future cash flows worth more. But as interest rates go up, the exact opposite happens. So as interest rates spike, that 50 basis point move in the 10-year was a huge culprit and big reason why you saw that big sell-off a couple of days ago on the heels of that hotter than expected CPI report. And we're actually, on the heels of that report, we're hearing some economists and market pundits suggesting that the Fed could even delay further rate cuts. And that was really what spooked the market. And this is kind of what we've been counting on all year long as we've done these podcasts, as we've written these newsletters to our customers and the weekly blogs. This history would say in an election year, generally you get off to a nice start. We definitely did. We hit new all-time highs in the S&P, over 5,000 for the very first time. You typically see towards the latter part of February, early part of March, some volatility just due to the fact that we're done with earnings season at that point. And now everybody gets to focus on all the other things to be worried about. And in this instance, the main worry is, when are we going to get that rate cut? We thought we were going to get one in March. There was more than a 50% probability of that priced in the market at some point in time in January, which we're only in February. That wasn't that long ago. So now that's being priced out. Yeah, that's causing some of the volatility. And I think that this is going to stick around with us for a little while longer, because I don't know if you know this, since we've been talking about the Fed and Jerome Powell for 2 freaking years now, but I don't know if anybody knows this or not, but they do not give you a heads up. They're never going to come out and say, hey, public, there's like a 97% chance that we're going to start to cut rates here in May or June or whenever they're going to talk rate cuts, right? Not going to happen. So the market's going to be curious, since they don't know when the Fed is going to make that decision or if they'll make that decision. And all of that uncertainty will typically cause a lot of volatility, which is why rebalancing your asset allocation is extremely important. So asset allocation is just a fancy way of saying this is how much of your money is invested in stocks versus bonds and cash. Very good. Now, the cool part about that is that asset allocation, the way that you slice and dice it between stocks, bonds, and cash, that explains 94% of the variability of performance in your account over any period of time you want to look at, which should be good news to the individual investor because you have full control over that asset allocation. Last year was a great example for us. From an outperformance standpoint, we outperformed because we overweighted the tech sector. There's a lot of reasons why we did that. We didn't just finger in the wind guesswork, like, oh, tech might be a good place to overweight this year. Just
total shot in the dark here. Let's go with tech.
Yeah. Not how that went down. Go read the newsletters and watch the podcast from, like January, February of last year. And you'll kind of see where we're coming from here about how we can control the asset allocation. But we made a lot of money in tech. So we took a lot of profits out of tech late last year, early this year for taxable accounts. We redeployed it into the asset classes we like the best this year from a historical standpoint when we're in an interest rate cutting cycle. Small caps being one of them, financials. We like the home builders, of course, as interest rates are expected to come down with the housing demand shortage that we have. And of course, industrials and technology will do great in an interest rate cutting environment also. But because of the hotter than expected CPI print, and because we're wrapping up earnings season, and because history would say there's generally some volatility towards the end of Q1 during a presidential election cycle, we went ahead and took profits that we've made from early January. We went ahead and sold a lot of those gains for our customers across all the accounts. We did that right after we got that hotter than expected CPI print. So we missed out on some of that downside risk, which is by design. Obviously, we don't want to participate in a market sell-off like that if we can avoid it. And we're going to use that cash to clip a 5% coupon in a money market. So Schwab has their free money market essentially, and paying about 5% APY. So we're going to sit on some of that cash for a little bit of time here as we wrap up earnings season, and expect to redeploy that during what I would anticipate being a more volatile March, due to the fact that rate cuts are not going to happen in March. We're not going to know when we're going to get our first rate cut, and that's the only thing that anybody's going to want to talk about. They're not going to want to talk about the excellent earnings season that we just had. They're not going to want to talk about how robust the job market is, or how strong the U.S., corporate America has become. in the face of all these different headwinds, from interest rates to election year to geopolitical risk to everything else that you could potentially be worried about. The market's really just going to be wondering when and if and how many times we're going to get an interest rate cut. So I want to be prepared for that and buy into the nervousness that others are going to experience. I don't know when we're going to get that first rate cut. I believe that we'll probably see our first rate cut in May, but that's to be determined. So I want to be prepared as possible by controlling the allocation for our customers, taking some profits so we're not giving them back to the market if we do in fact experience more volatility. But hey, here's the great news. Even if we're wrong about the volatility, let's say we had no volatility at all, which, let's be real, there's never really been a full market year where there's no volatility to speak of. But let's just assume that were to happen. And you're saying, hey, Casey, you got all this cash sitting on the sidelines that's not participating, or at least some of it's, not participating in the asset classes like the best. Well, we're still up on the market quite a bit. And I don't think anybody's going to be too concerned if we miss the first 1 or 2% on the upswing when we're protecting clients on the downside. So within a tenth of a second, more or less, we can essentially have every account fully positioned with the way the technology works these days. So the point is to understand what history has to say so that you know when, as an individual investor, to pull the trigger from a rebalance perspective. You're seeing Warren Buffett do this right now. Just this morning, he sold millions of shares of Apple. Now, he didn't sell all the shares. He didn't even sell a significant percentage of shares. It was just by far and away the largest holding is in his account. Apple, like a lot of tech stocks at the beginning of this year, had a great start, so he went ahead and trimmed the position. He's also buying U.S. Treasuries and money markets and those types of vehicles. But he's also redeploying some of that into other sectors of the S&P stock-wise, such as Chevron and Occidental Petroleum. A couple big energy stocks he also holds within his account. So that's what Warren Buffett's doing. He's done that very well for over 60 years, and the results have proven that. So we're taking all the same sort of measures and steps that we believe, a younger Warren Buffett and Charlie Munger would have done. Obviously, they're still using those same principles to this very same day, and we're trying to follow in those footsteps. And we start out with understanding what is the risk, what does history have to say about that risk. Now let's put the probabilities in our favor from an allocation standpoint. But we have to continue and diligently understand what the next risk potentially is from the view and lens of the individual investor in the marketplace. And I would anticipate, given that earnings season being very close to being over, and with a great earnings season, really strong consumer, really strong U.S. economy. But the fact of the matter is nobody's going to know, and Fed Chair is not going to give you any indication as to when that first rate cut's going to be. So just be prepared for a little bit of a roller coaster ride here as we're wrapping up Q1. So that was kind of the highlights of everything that happened here recently. From a data perspective, we answered some tax questions for customers, kind of gave you guys our take on the CPI data. But the one thing that we did leave out is why we kind of are fading, meaning that we're not really on board with this hot inflation print repeating itself. And 3 of the 4 culprits are the reasons why. So I'm going to run through this real quick as so shelter, so owner's equivalent rent, shelter, that was a huge percentage. Owner's equivalent rent, shelter. So again, the core CPI month over month in January was 0.39%. Shelter accounted for 0.26% of that. Auto insurance accounted for 0.5% of that. So just between the shelter and the auto insurance inflation, I mean, that was damn near the whole thing. If you take those 2 pieces of data out, your core CPI is running at 0.8% month over month. That's 1% annualized. So to us, inflation is still falling, and it's kind of falling like a rock because the owner's equivalent rent, shelter, that's an extreme lag. If you look at any sort of leading economic indicator, which I had some data points here, if I can find it real quick, as you would see that is actually not something that should bother the Fed whatsoever. Here it is. So Renaissance Macro tweeted this, or I guess they posted this on X. They highlighted that owner's equivalent rent surged higher to 6.94% year over year, while rent of residence, so this would be like an apartment complex, right?
Okay.
So owner's equivalent rent is saying, hey, Ez, you have a house. If you were to rent your house, what would you rent it for a month? And you're just throwing out a number, right? That's what owner's equivalent rent is, just a survey. But rent of residence is actual like apartment complex. Like you are here to rent. You are paying a rent, and here's what it is. So the actual rent of residence fell to 4.44% year over year. So that divergence of owner's equivalent rent survey versus what renters are actually paying, that divergence is pretty substantial. They pointed that out. Obviously, that's not something that the Fed, I don't think, is too concerned about. And there's really nothing that they can do. Whether they leave rates the same, increase rates, decrease rates, it's really not going to have an immediate impact on anything having to do with owner's equivalent rent. That is a very, very long lag effect, and the Fed has acknowledged that multiple times. The auto piece, that's just the catch-up that these insurance companies have to have because the EV market, those are more expensive to fix. The fact that car prices went up during the pandemic due to the supply chain shortages, chip shortages, et cetera, that costs more money to make a car. That's now being passed along to the insurance companies that have to, make these claims and fix these issues, and that costs them more money. So they're increasing the premiums that you have to pay on your auto insurance. None of those things, either of those things, should the Fed worry about because there's not a damn thing that they can do about it, whether they keep rates the same, raise them, or reduce them. This is just something that takes a little while to work through all the data. The other thing that stood out here in the CPI print, we did have miscellaneous personal services, which is essentially financial services, had a surge in inflation by a small percentage. That mostly has to do with the fact that the market's positive. So if the market's positive, that has a little bit of financial services inflation component to it because if you're charging a fee for the assets that you're managing and those assets go up in value, your fee just got a little better if you're collecting that fee. And then on the same side of that, hospital services did see a surge in inflation. I don't really have a good answer as to why that is. But 3 of the 4 culprits that actually showed positive inflation in that last CPI report that we got 2 days ago, 3 of the 4 are very explainable. Nothing that the Fed can do with owner's equivalent rent, auto insurance, and of course, as the market goes up, it's just going to make a small blip of inflation for the financial services sector of the many, many things that they use to calculate CPI with. So that, in a nutshell, is the reason why I'm not freaking out regarding that inflation print that we got a couple of days ago. I don't think investors should be freaking out. I think that this dip that we're seeing is going to be extremely viable, but I do believe that you're likely to see a bigger pullback as we wrap up earnings season here because there won't be anything else to talk about other than when the Fed's going to cut, and the Fed's not going to give you that answer. So I would expect some volatility as it relates to that. Yeah. There you go. That's what we got. I don't know how long that was, Ez, timing wise.
We're just under 40. We're breezing through it today. So
yeah, we came out swinging. We got a lot of information to our viewers and audience today, and we were glad to cover the tax questions. Glad that we were able to cover some of the macroeconomic news. The earnings news has been awesome.
Yeah.
Obviously, we gave you the CPI data and our take on that and kind of how we've been repositioning some things for customers. So hopefully that's helpful.
Yeah, I hope so too. I'm sure it has. I mean, that whole thing with the Fed not announcing. I mean, we've talked about the Fed and Jerome Powell's decision making specifically. I feel like I know him so well. I could like write a Tinder profile for him, and the first thing on there would be like, "I'll never announce when I'm cutting your rates." Like that would be the first thing that I put on there.
Yeah, I could. Yeah, that would be hilarious. Like that's definitely got to be like an SNL skit, maybe.
Also, hedge master is what we could call him. He's always just going to be like, "Yeah, it's good, but."
Oh man, it's a interesting thing to be a Fed official.
Man,
I can't imagine how the actual. I wish I knew. I wish I could be a fly on the wall when they actually all get there and they start talking about stuff. Like I know they give you the minutes, but there's got to be some redactions in there. Like I'm sure they're not like. I'm sure somebody was like, hey Jerome, shut up, and that got redacted.
Yeah. They're like,
I wish I knew what that was though.
Like, you know the rules. You can't talk unless you're wearing the magic hat, and like that gets like wiped out of there. Or hey, do this
Uh,
shot. You know, it's like yell, do this shot before you talk.
yeah, well, can you imagine? Like, you got a lot of different characters in the room, and before Jerome, it was Janet Yellen. She was running the show there, so I mean, it's a interesting group of financial professionals there. Their view on the world to me is definitely different, and I disagree with a lot of it. But they're not taking my phone calls. Um, they haven't left
They
us any
haven't called you
comments.
back yet.
I've been asking for Jerome to be on the show for a couple years now, so
Yeah,
he seems preoccupied. But
I'm
we'll
pretty sure
continue
they
this.
blocked me on every possible situation. Like, stop calling us, Ezra. We're not coming on your podcast.
Okay, we're still going to talk about him anyway, though. So.
Yeah.
I know you're listening, and I hope that we can be on the same page at some point here in the near future with our first rate cut. But anyway, we're going to keep doing this every 2 weeks. So we'll keep this train rolling. 2 weeks puts us right around right at the end of February. So the next time we come out to the viewership here, Eds, we'll be wrapping up 2 months of the calendar year.
It may be a leap year special. That's exactly 2 weeks from today. So we get a leap year this year.
Yeah, it's trippy, right?
Yeah.
Got to be our first leap year, given that this is season 4, right? So that's a first. So looking forward to that. If you guys have questions, please let us know. You can text me 513-630-2664. You can also post them right here on YouTube Live, right on the platform that we're on, right?
Right on the platform. If you are watching the live streams and you have questions, please drop them in the chat. Otherwise, if you're catching this after the fact, you can drop a question in any of the comment sections, and we'll make sure Joshua gets to them and answers them on the next episode.
Yeah, it's been a lot of fun. We enjoy this very much. We appreciate the support. Don't forget to like the podcast, turn on your notifications. That way, every time we drop this thing, you'll get a little bit of an alert saying, hey, this is out there for you to take a look at. And, of course, we'll be doing this again right around the same time right here, YouTube Live, end of February, typically right around 11 o'clock. We do these things. So we appreciate the questions. We'll continue to address those up front, and then we'll get right to the meat and potatoes of our topics. But with that, I hope you guys enjoy your first week of pitchers and catchers. And be getting ready for brackets by about the next time that we get together here on the show. So I'm looking forward to that.
Yeah. We'll have plenty to talk about that.
Absolutely. Well, I hope you guys have a great rest of your day. We'll get back to you in a couple weeks.